price of gold has been rallying. Economic uncertainty, geopolitical tensions, ETF appetites, and central bank buying have been fueling bullion. Earlier, we spoke with Daniel Ghali of TD Securities, who covers gold. Here's more on what he had to say about the rally.
I think, central bank buying activity in gold has been a secular trend. So if you look through history, since 2010, I'd say, the breadth of central banks buying gold has started to increase. And the fact of the matter is there's a really wide variation as to why these central banks are buying it. The de-dollarization narrative has been spoken about. More recently,
some countries just not wanting to own U.S. dollars.
Or to diversify away from the U.S. dollar, partially. But I actually think that what's been more relevant in that stream of buying activity in gold this year has been buying gold as a currency depreciation hedge. So if you think about the start of the year, we actually started off the year with a pretty stellar rally in the U.S. dollar. This is very counterintuitive, but if you're a country who wishes to diversify away from the U.S. dollar, you might take advantage of those moments in time when the U.S. dollar is pretty strong in order to sell U.S. dollar-denominated assets and buy non-U.S. dollar-denominated assets, one of which is gold. So that currency depreciation pressure is really what counterintuitively has been fueling central bank buying activity in gold this year. And in the latest rally, that's no longer the case. Right, over the last few weeks, the dollar has weakened substantially. So we think this mystery buying activity, which we've dubbed it as, has stepped away. But here's the beautiful part about the setup in gold this year. You actually have almost perfect diversification in terms of the large drivers of gold buying. On the one hand, we spoke about if the dollar rises, central banks, mystery buyer steps in. But when the U.S. dollar subsides, the Western investor cohort also tends to buy gold. That's the traditional case for purchasing gold.
Inverse relationship.
The inverse relationship to rates, to the dollar, and so on and so forth. So that's what we think is really occurring today. In fact, this is a setup that should really fuel fear of missing out in gold, because macro funds have liquidated a substantial amount of their holdings over the last weeks. And as gold prices break into new all-time highs, they have to reallocate into it.
So that's interesting. Speaking of fund flows, like Bloomberg Intelligence had some data suggesting that hedge funds had been large buyers of the Bitcoin ETFs that launched in the U.S. last year and may have been some of the more prominent sellers recently. I know you focus on gold, not Bitcoin, but for a while there, it was hard for gold to get a word in edgewise because everybody was talking about the cryptocurrency opportunity. But does the volatility in cryptocurrencies, when investors are getting a little skittish around risk assets, do you think that's another consideration helping gold right now?
It does play a role in my view, but only indirectly.
Okay.
So, people talk about gold as a substitute for Bitcoin and vice versa. But the fact of the matter is fund flows into Bitcoin ETFs are completely uncorrelated with fund flows into gold. They're two separate investment cases, actually. And what's interesting is fund flows into Bitcoin ETFs are much more highly correlated with fund flows into risk assets. So in a way, the deterioration in risk sentiment, this slump in U.S. equity markets that we've seen over the last few weeks have actually kept risk budgets constrained. Macro funds haven't purchased gold in a moment of time where you would expect them to because of those constraints. But at the same time, it's not really directly related to Bitcoin.